How's it going, everybody? This is Jose from the Stock Market 101 channel, and I hope you guys are having an amazing day. And as always, if you guys have not checked out my latest videos, I suggest you go check them out real quick, and let's get right into it. Okay, so today we're going to be talking about some frequently asked questions that I receive basically on a daily basis with some friends that are interested into the stock market and are starting to look into it, but they're not really sure if they should get into it right now. So we're going to be going over that, and we're going to be going over some terms and their definitions, and I'm going to give you my opinion on why I got into the stock market as well closer to the end of the video. So let's get right into it. One of the questions that I get asked a lot is there actual evidence that I'll make money buying stocks, right? When I started getting into the stock market and I started telling people that I started doing it, they all told me that they got into the market and they started losing a lot of money and then they got out. So they're saying, how do you make money in the stock market? Because I hear a lot of people actually lose money in the stock market. And that's true in a sense. When you're in the stock market, people think that it's like a get rich quick scheme, if you know what I'm saying. That there's a saying that 90% of traders lose money, they're not successful. Well, that's trading, right? Like day trading, stuff like that. And that's not really my philosophy when it comes to being in the stock market. I'm more of a like medium to long term investor. So I choose companies for the longer term, not for the immediate future. Also, according to historical records, the average annual return for the S&P 500 from 1928 to 2017 is approximately 10%. So from this time frame, which is like 90 years, if you just hold for that time frame, you can average a 10% annual return. And this might be a little tricky to understand, but it's not 10% every single year. It's going to be like 10% one year, 10% the next year after that, 10% the next year after that. No, it's not going to be like that. Some years you might have a really good year where you can get maybe 20%, maybe 25%, and maybe the next year you go down 5%. It's going to be different every single year, but the average is 10%. So if you just hold for longer terms, the probability of you gaining money is higher than just day trading like that. And especially if you don't have the time to day trade, it's not really the appropriate thing to do, because a lot of people have that 9 to 5 job, which in the United States, when you're trading around that time, that's when the stock market is open. So you don't have that time to be checking on your brokerage account or your Robinhood or whatever you're using to be trading like that, because most people don't have the time to. So I think the best strategy is just to buy and hold for the longer term, so you don't have to be always on your phone or on your laptop looking at your stocks nervous. Because I remember when I was day trading, I was nervous. I was in college, I was freaking checking on my Robinhood every single day buying, because I was scared. I bought something and I was like, okay, hopefully this comes up or not. And that's not a way to do it. And also, there you could make money day trading. You have to find that strategy, and I couldn't find it, and I didn't have the time to be always on my account checking everything. And I think being a long-term investor is more sustainable, and it'll minimize the exposure of market volatility. Like I was saying, in the short term, there's going to be going up and down every single day. Maybe it'll go up 5% in one day, it'll go down 5% in one day. And if you're holding for the long term, you really don't care about these little short-term swings. When you're a long-term trader or when you're a long-term investor, you'll just avoid these swings, because you might buy or sell based on your emotions, and you might be panic selling, which you might sell for a loss. Well, maybe in the next month, or the stock that you chose could potentially come back to where it was or even higher. And another question that I get is, what is a decent return for non-professional investors? So like I said, over the past 100 years, the stock market is averaging around 10% rate of return. So based on that, your stocks could potentially double the value of your money in just over 10 years. But keep in mind, it doesn't mean that you're going to be making 10% every single year. Some years it goes up more, sometimes it might go down a lot more. So just to be safe, like the average investor might get a 7 to 8% return per year on average. But the more you study and the more you're into the market and the more you're passionate about it, you could get higher returns. Just in this year, if you were just invested in Apple, you would have got a 50% in 1 year return for Apple. And Apple is the biggest company out there. Look at this. Apple has a $1.1 trillion market cap. If you were just holding this alone, 50% in 1 year, that's amazing, especially at the time that we are now. The market's been doing very well. We don't know if the next stock market crash is going to happen. And if you're a long-term investor, you can just average down on your positions, and over the long term, a stock market crash in 20 to 30 years wouldn't really mean anything to you. Another question that I get is, what are the most important indicators to check on a stock's health or to see if a stock is good or not? Well, all publicly traded companies, they all issue quarterly earnings reports by the SEC. So you can find key pieces of data in the reports to evaluate how good a stock is or not. One thing that people really look at is earnings per share, or EPS, which is a ratio of total earnings divided by the total investor shares. And you could use this number to compare like other stocks to each other. Another one that most people use is the PE ratio, which is the price to earnings ratio. This is basically what customers are paying for a dollar of the company's earnings. According to the FINRA, the long-term average number has been about 15. A stock with a high PE ratio might mean that the future has high growth potential, that people think it's going to be, that the company is going to exponentially grow in the future, but it will have to work harder to maintain that performance. A low PE might mean that a price increase is on the way, or it could also mean that the company is in trouble. But keep in mind that you cannot pick a stock just because of these two indicators. It all depends on what you're looking for. What do you want in a company? Like if you want a higher return, that means you might have to take a higher risk on a company. You might not see these two indicators as important as other things. That's why you should probably do your independent research and then form your own educated opinions based on what you see in the company. Another question is, where can I find analyst research and recommendations on a particular company's stock? So one website that you might want to use is Yahoo Finance, which is free. You can just look it up, and then it has all the information on here, which is pretty useful if you're new into the stock market. Or most brokerage firms, they have their own information on their websites or on their apps. So another question that I get is, what is a dividend? So not all companies pay a dividend, but a dividend is a portion of the company's profit that is paid to the investors, which is typically on a quarterly basis, which is every 3 months. And this does not show the health of the company, but a dividend is essentially like another way that a company can use to bring in more investors into their company to become shareholders. Though some investors use dividends as a longer term strategy, a higher dividend yield doesn't necessarily mean it's favorable, because that means that there is little room for it to grow, and it also may not be sustainable for the long term. But instead of looking for a higher dividend, you might want to consider like a dividend stock in a sector that has room to grow. What does it mean to short a stock? Well, investors short stocks when the stock's current trading price is thought to be overvalued. In this process, the person that shorts a stock is essentially borrowing the stock from a brokerage and sells it to another buyer. If the stock price goes lower, the investor who shorted the stock profits from the difference in the buy/sell price after repaying whatever is owed to the brokerage house. To short a stock, you have to be using a margin account, which lends you more money to trade than you actually have in the account at a fixed interest rate. And I wouldn't even suggest shorting a stock if you're new into the market, because if you don't cover your shorts, you have the chance to lose more money than you have in your brokerage account. So the opposite would be going long on a stock, meaning buying and holding a stock for an undetermined amount of time. And that's what I suggest people to do, is just buy stocks that you believe that will keep on growing into the future. Another question I get is, what is a ETF and if you should buy one or not? Well, an ETF is an exchange traded funds. It combines the flexibility of a stock with the low costs of a mutual fund. But unlike a managed mutual fund, most ETFs trade on stock indices, meaning that their price is always changing like a regular stock. Like you see here, it's going up and down, and you can buy and sell them at any time based on the current price. One good ETF that you can look into is this one right here. It basically tracks the S&P 500. And if you just hold your money in this and you just want to put your money in without really tracking anything, this might be a really good one. As you see here, in the past year, it's up 18%, which is very good. Both last year and this year, it's been very good years for the stock market. And as you see here, the 5 years, almost doubling your money, around 92%. So essentially, if you put in $10,000 5 years ago, you could have made which is very nice if you're really not into doing all the work. But like I said, like you can go into individual stocks. If you would have just got into Apple 5 years ago, your money would have been multiplied by a lot. As you see here, it's gone up quite a bit. But if you would have just got 100 shares right here at 62.88, your account would be at $22,000. Your money basically more than tripled, which is that's amazing growth right there. Okay guys, that's gonna be the end of the video. If you guys are new to the stock market and have any other questions, leave them down in the comments below. And I'm going to make like a series about this for people that want to get into the stock market and that are new. And that's one of my goals for this channel, is to get more people into the stock market. But other than that guys, drop a like, subscribe, turn post notifications on. I'll see you guys in the next one.